When thinking about retirement, there's often one big question that comes up. And that question is, can I really afford to stop working right now? The answer depends on several factors, but your federal pension is a key part of that decision. In this video, we're going to discuss and focus on how to assess your future pension payments because there's often a big gap between your gross pension and what you actually receive each month. But before we dive into the details, welcome to the Money Briefing. My name is Jarrell Harvey and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. As a federal employee, when you look at the biweekly gross pay on your leave and earnings statement and compare it to the biweekly net pay, you may feel a little discouraged because deductions take a big chunk of your check. And the same thing often occurs in retirement. There are several things that can significantly reduce and deplete your monthly pension check. Many times, when people calculate their own estimated pension or get a quick estimate from one of the benefit platforms like GRB, they may not fully consider all of the different factors that could lower their pension payments. Therefore, I want to highlight the main factors that could impact your pension so that you can get a better sense of what your true take-home pay may be. Generally, I organize the primary reductions and deductions into 5 categories. These areas include penalties, survivor benefits, court orders, insurance premiums, and taxes. So let's first start with penalties. The most common type of FERS penalty is the age reduction penalty. This applies to federal employees who retire under the NRA plus 10 rule. This type of immediate retirement allows FERS employees to retire at their minimum retirement age with fewer than 30 years of service. However, if you retire under this provision, your retirement annuity is penalized and reduced based on how many months and years that you are under age 62. The monthly reduction is equal to 5/12 of 1%. This chart shows how the monthly reduction breaks down based on percentage. A full year is equal to 5% reduction. In other words, if you start your pension immediately after reaching your 59th birthday with 18 years of service, your pension would be reduced by 15% because you're 3 years away from age 62. This reduction is permanent and it does not go away after your 62nd birthday. However, you can decrease or eliminate the age reduction penalty by postponing the start of your pension until age 62 if you have fewer than 20 years of service, or waiting until age 60 if you have at least 20 years of service. Another penalty reduction that affects far fewer FERS employees is related to unpaid or refunded service deposits. These penalties usually impact FERS employees who have a CSRS component in their annuity. Now, let's talk about how survivor benefits can affect your pension. When you choose a survivor benefit, your spouse or former spouse can continue to receive a portion of your pension if you pass away first. Under FERS, you can leave your spouse up to half of your monthly pension as a survivor benefit. Choosing the maximum survivor benefit of 50% will lower your monthly pension amount by 10%. There's also a smaller partial option where your spouse would get 25% of your pension if you pass away first. This choice reduces your monthly pension by 5%. If you decide not to leave any survivor benefit, your monthly pension won't be reduced while you're alive, but your pension payments will automatically stop when you die. Also, it's important to mention your spouse can only keep your FEHB health coverage after your death if you pick a full or partial survivor benefit. If your spouse dies before you, you can stop paying for survivor benefits, but you won't get back any money that you already paid in. Another factor that can reduce your annuity is a court order. These reductions typically arise from divorce proceedings. Court orders may lower your annuity by requiring survivor benefits for a former spouse, as we just discussed, or by reducing your monthly annuity right after retirement. The court order must instruct OPM to pay a former spouse based on a fixed dollar amount, a percentage, a specified formula, or a simple pro rata share or marital share. In most divorce cases, the court order will use the marital share approach. This means the former spouse's share is based only on the time you work as a federal employee while married. Service time before the marriage or after the divorce usually does not negatively affect your pension. Typically, the former spouse's share cannot exceed 50% of the total annuity. So, as an example, let's say you were married for 10 years of your 25-year federal career. That means 40% of your federal career overlapped with your marriage. If the court order awards your former spouse half of the marital share, they will receive 50% of the 40%, which comes out to 20% of the total annuity. If your former spouse was not awarded any portion of your annuity or no survivor annuity, then it's a non-factor to OPM, and you can respond no to question 2 under Section C on the immediate retirement application. So the first 3 factors that we've covered won't apply to every federal retiree, but the last 2 factors that we'll discuss usually apply to most retirees. A big deduction in your pension check will come from insurance premiums. There are several types of insurance premiums that may be deducted from your pension, including health insurance, life insurance, dental and vision insurance, and possibly long-term care insurance. Your health benefits through FEHB are likely the most important insurance to keep during retirement. You can change your health plan each year during open season. As a retiree, you receive the same benefits and government contributions as an active employee. So your health insurance premiums will cost the same as when you were working. However, with FEHB, there are 2 key differences to consider. First, the premiums affect your taxable income differently. While working, your health insurance premiums come out of your pay before taxes, which lowers your taxable income. After retirement, premiums come out of your pay after taxes. Second, your payments will change from bi-weekly to monthly. For example, if you currently pay $240 every 2 weeks for FEHB coverage, multiply 240 by 26, which is the number of pay periods in a year, to find the annual amount. Then divide that number by 12 to get the monthly amount, which in this case is $520. You should perform this same type of calculation for all your insurance premiums, since they will also switch from bi-weekly to monthly deductions. Another important insurance decision involves your FEGLI life insurance coverage. You need to decide which coverages to keep or drop and what reduction levels to choose starting at age 65 for any coverages that you maintain. Lastly, I want to cover taxes, which is one of those things that seems to find us whether we're working or retired. Your pension will be taxed as ordinary income, and you will be required to pay federal income taxes on the majority of your pension pay. As a FERS employee, you contribute towards your retirement pension every pay period. The tax-free portion of your pension is usually a relatively small part of your check. And for the general retirement planning purposes, it may be easier to assume the full amount as taxable income. When you complete your retirement application, you will usually fill out a Form W-4P, which will help OPM estimate the correct federal tax withholdings for your pension, which helps limit the chances of underpayment or overpayment throughout the year. However, as a retiree, you can stop or change the amount of your withholdings from any of your annuity payments by logging in to the Retirement Services online portal. You can also elect to have state taxes withheld from your pension on the portal. There are currently 9 states who do not tax income at all, and there are several other states who exclude pension income from taxation. Understanding how reductions and deductions can affect your FERS pension is an important step in evaluating your retirement readiness. Penalties, survivor benefits, court orders, insurance premiums, and taxes can all significantly shrink your pension payments. For factors that you can control or eliminate, you should consider the cost, the value, and any alternative options to that reduction. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com, or you can click on the meeting link in this video's description. Thank you for watching. We'll see you on the next Money Briefing.